Hey, what's up everybody? It's your guy Frank, founder of Cobbs Capital, and today I'd like to introduce you guys to a new segment called Decoding the Stock Market Matrix, where we cover various tips, strategies, and fundamentals to help you with your investing. So today, guys, we'll be talking about the RSI. RSI, in short, stands for Relative Strength Index. What this does, this is a momentum indicator, meaning that it evaluates current stock price movements, changes, and volatility. And as it evaluates this over a set period of time, it's going to give you a factor, or it's going to show you as a trader or investor whether or not a stock is overbought or oversold. This was a strategy and or indicator developed by J. Wells Wilder in 1978. Why he was using it back then, can't really tell you, but now it's very helpful because we're always using different technologies to help give us an edge with our trading. So whether that be MACD, RSI, etc., we're always using it. But personally, I use RSI quite a lot. Now, when you're looking at the RSI and to go a little bit more into depth, what this does is it's basically going to compile data from the last 14 periods. So whether this be the last 14 days, last 14 weeks, last 14 hours, whatever time frame you are using, is going to take that current data, that current relevant data, and show you, okay, a stock is now overbought or a stock is now oversold. Now, you might be sitting there asking, okay, Frank, well, you're saying all this about RSI showing me if a stock is overbought, oversold. How do I use that to my advantage, and what exactly is a value of being overbought and oversold? Glad you asked. We'll get to that. So in terms of the, being overbought, oversold and the values, what that's going to do is you're going to look at a purple channel or a channel in general on your chart, whether this be on TradingView, Thinkorswim, whatever brokerage account you're using. It's usually going to show you that if you pull up your technical indicators. So when you have up your RSI chart, it's going to give you a value or a range of numbers from 0 to 100. 0 being completely oversold and 100 being completely overbought. Naturally, most stocks don't go all the way to 0. Most stocks don't go all the way to 100, but they do fluctuate very heavily or in a very volatile manner in between. So usually when I'm trading, and a lot of other traders, what they'll do is they'll set their overbought level to 70 and they'll set their oversold level to 30. The reason being, if you have your channel set up to 70 and 30, once it gets above 70, it's a clear indicator, or you can just quickly glance at your chart like that and say, oh, okay, I know this is overbought. Or if it dips below 30, you're like, oh, okay, I know it's, headed to 30, or I know it's oversold, whatever. Some traders like to do 80-20, but the thing about 80-20 is once you do that, or you set your ranges to that, you'll only see the stock fluctuating in between the channel. You won't really see it break above the channel or below this RSI channel. So that's really why I don't personally use it. And, setting it to 0 or 100, that's really going to take more time than it really is necessary to really figure out if a stock is overbought or oversold. Another thing too, when you are using the RSI, is to figure out whether you are seeing bearish and or bullish divergence. Bearish divergence meaning that as a stock is overbought, or as the RSI is showing, overbought level, the stock is making lower highs. So meaning that the stock price, it has reached a peak, and then, the next hour, the next candlestick you see on the chart, that's an even lower high than it was. And you're already seeing on your RSI chart that it is overbought. So you're saying, okay, well, we have a value of 80 on the RSI, clearly overbought. And, our stock, is now trending just a little bit downward. The past couple of hours, it hasn't been as high in value as it was, earlier in the morning, earlier in the day, or whatever. And then this also corresponds with pretty much the lower lows that you see on the RSI chart as well. So with the bullish divergence, what you're pretty much going to notice is that your RSI is at oversold levels. And these RSI levels, once you see that it's at an oversold level, so whether this be, from like below 50 trending down like 40, 30, whatever value, even 2019 sometimes I've seen. If you see it trending downward and you're seeing the RSI kind of reach a low and it's hitting not lower lows necessarily, but it's stabilizing within this oversold region. And then as you look at the actual stock price, you're starting to say, okay, well, the stock is actually, is kind of making higher lows. So for instance, the stock was, at this very low peak during the morning period of trading. Afternoon, it was a higher low, etc. That's bullish divergence, because basically the price is rising and it's showing you that the trend is reversing from this oversold area. And that's also how you can use the bearish divergence, bullish divergence to help your trading. So other than that, guys, that's really it for the RSI. That's how you can use that. Again, you might need to be a little bit more familiar and kind of get used to using that regularly when you are trading or investing. But for me, it personally helps quite a bit, because when I am day trading, swing trading, or just buying up general equity, I always like to buy in at very low points. Or, you guys probably hear the term all the time, buy low, sell high. You can only buy low, sell high if you know if a stock is overbought, or if you know where the value and ranges are, where it is overbought or oversold. So that's how this relative strength index or RSI can help you. Hope you enjoyed this episode of Decoding the Stock Market Matrix, and I'll talk to you guys later. All right.